Welcome to the deep dive. Today, we're cracking open a fascinating and pretty contentious topic, the hunt for the holy grail of investing.
We have a great set of sources here. They're all centered on a huge financial book release, and we get to see the promise and then let's say, the immediate and very real backlash from people who tried to follow its advice.
And that's the core of this deep dive, that tension. You
Yeah.
have this high-level pitch about alternative assets, things like private equity, venture capital, which are, normally just for the big guys, the institutions.
Right. And the big question is, has that door finally been kicked open for you, the individual investor?
Right.
Or is it, well, still bolted shut?
Okay, so let's unpack this. Our mission today is really to explore that conflict. We have the book's promises on one side, and then we have the real-time reactions from a, frankly, very critical Reddit thread on the other.
So we'll start with the pitch. We'll lay out the strategies, the big names involved, but then we have to pivot to what happened on the ground. We'll focus on the three big points of friction: access, fees, and transparency.
It's really the story of a big idea hitting the hard wall of reality.
Exactly.
So let's start with that big idea. This book was set up to be a blockbuster, right? The final part of a trilogy on financial freedom. And it promised insights from, well, a dozen of the world's top investors.
And the scale here is it's staggering. The people interviewed for this book, they collectively manage over $500 billion. These aren't just successful people. They're literally moving markets.
Absolutely. Like, the source's name, Robert F. Smith from Vista Equity Partners. He's widely seen as the best enterprise software investor in history, period.
Then you've got Vinod Khosla, a legend in venture capital. His story is mentioned, the one about turning a $4 million investment into, what was it?
A $7 billion windfall? It's the kind of return that, makes you sit up and pay attention.
Of course. And they also feature Michael B. Kim, who's called the godfather of private equity in Asia. This is a guy who built the biggest PE firm on the continent, became South Korea's wealthiest man. When you line up names like that, expectations are high.
They're sky high.
And the strategies they talk about they're exactly where the big institutional money is flowing right now.
First up was private equity, or PE. And it was framed as, well, more than just an investment. It was a way to become an owner of the firms that manage the assets themselves.
Yeah, that's a key distinction. Most people, if they invest, are limited partners, or LPs. They provide the cash. But the real money is in being the general partner, the GP. They control the assets, collect the fees, get the performance bonuses.
And the book's promise was to give you a taste of that GP side of the equation.
Right. Then they push private credit, calling it the new fixed income solution. With traditional bonds paying so little for so long, this was pitched as a way to get returns that are like 2 to 3 times higher.
And of course, you can't forget private real estate.
Never. The classic inflation hedge, something that holds value when cash doesn't. Plus, it can generate tax-friendly income.
But the really interesting stuff was in the novel assets category. They were talking about investing in professional sports teams, the MLB, NBA, NHL.
Which is only recently possible for big funds. And they also highlighted the massive investment wave around the energy evolution, the green transition.
So it's this incredibly compelling story. Get access to the best deals, learn from the smartest people, and, leave the boring old public markets behind.
But this is where this story hits a bit of a snag. It raises the big question: if this is all so great, why did the reaction turn so negative so fast? Did the book actually open these doors for anyone?
And the sources show that for a lot of readers, the answer was a very quick and pretty painful no. That Reddit thread just blew up.
Yes, and the first major criticism was about a perceived conflict of interest. People felt the book wasn't really a guide, but more of a very long sales pitch for CAZ investments.
A firm the author has a major stake in.
Exactly. And that sales pitch immediately crashed into the hard wall of financial regulation, the gatekeeper.
Right. Readers got excited. They called up CAZ, and then what happened?
One of the sources posted the actual email they received. It said, and I'm paraphrasing here, "But because you are a non-accredited investor, the current rules mean we legally cannot let you invest in anything we offer."
Wow. So it's the ultimate financial irony. You buy a book to learn the secrets of the rich, and the secret is that you're not rich enough to use the secrets.
That's the gist of it. And it got worse. Other commenters confirmed that even being a standard accredited investor, which is already a high bar, $200K income or $1 million in net worth,
Yeah.
even that wasn't always enough. Many of these deals require you to be a qualified purchaser, or QP.
Okay, a QP, that's a whole other level, isn't it? What's the threshold for that?
It's a huge jump. A QP often needs something like $5 million in investments, not just net worth, so the gap between the average reader and the entry point isn't a small step. It's a canyon.
The book framed the barrier as knowledge, but the readers found out the barrier was just net worth.
That's the core of the frustration. The Titans are sharing their playbook, but they're playing a game with a totally different set of rules than you are.
Now, there was one little glimmer of hope mentioned in the thread about that changing, right?
A glimmer, yes. There's some pending legislation that might, and this is a big might, allow people to take a test to become an accredited investor.
So it would be based on knowledge, not just your bank account.
Exactly.
Right.
It would shift it from being purely capital-based to competency-based, which is what so many people were so angry about.
Okay, let's pivot to the second big problem, and this one hit the people who could actually get in the door, the fees.
This is where things really start to unravel for anyone who knows their way around an investment, because access is useless if the cost of that access eats all your returns.
And the fees for the CAZ fund were not small. What were the numbers?
They were eye-watering. The fee was cited as 3.7% for the minimum investment of $25,000. It drops a bit to 2.7% if you put in $100,000, but that 3.7% is a massive drag from day one.
A drag is putting it mildly. One commenter did a little thought experiment that I thought was brilliant. They said, okay, let's say your goal is to make a 10 to 12% return, which is the promise.
Right.
To get that 10 or 12% after the 3.7% fee is taken out, the actual investments underneath have to be generating an internal rate of return, an IRR of almost 14% to 16%.
Which is,
Yeah.
that's a huge hurdle. The commenter made the point that very few healthy, legitimate businesses can sustain that kind of return without taking on, potentially catastrophic levels of risk.
So you're basically paying a massive fee for the fund to chase miracle returns, just so you can end up with a decent one.
And that's before any performance fees, which they'd take if they do really well. It's a classic heads I win, tails you lose setup for the fund manager.
Which brings us to maybe the most shocking part of this whole fee discussion, the idea of multi-layered fees.
This was a really critical claim from one source. The argument was that CAZ might not even be doing its own unique deals. Instead, it could be acting as a fund of funds, meaning they take your money and just buy stakes in other giant private equity funds. They named some of the biggest players, like Blue Owl and Dial.
Wait, hold on. So let me get this straight for everyone listening. You think you're paying one fee to firm A to get into asset X.
Right.
But you're actually paying firm A, who then turns around and pays a fee to firm B, who is managing
Right.
fund, who then finally invests in asset X.
That's the structure of a fund of funds, yes.
Yeah.
And every single one of those layers takes a cut.
So this source claimed that the individual investor could be paying...
Well, 4 layers of fees. You pay a management fee to CAZ. They pay a management fee to the underlying fund. That fund's manager gets a performance fee. And the managers of the actual companies get paid. The money just trickles down.
That is just incredible. And it's the definition of a lack of transparency.
It really is.
Yeah.
It makes Warren Buffett's advice to just buy an index fund for, 0.07% look less like a boring option and more like the only sane choice.
And on top of all that, there was a practical warning for anyone even thinking about this stuff, something about your taxes.
Ah, yes. The dreaded K-1 form. These kinds of investments are structured as partnerships, so they issue K-1s instead of the usual 1099s.
And the problem is...
The problem is they are always late. Always. The underlying companies have to do their books, pass them up the chain. You often don't get your K-1 until September or even October.
So forget about filing your taxes in April. You're automatically filing for an extension every single year.
It's another huge hidden cost. It just screams that this whole world is not designed for the regular person. It's for people who already have a team of accountants on retainer.
Okay, so if these exotic high-fee funds are basically a minefield, what did the community suggest as the reliable alternative? What's the battle-tested path for you, the listener?
The consensus was pretty clear and not very surprising. For the vast majority of people, the simple, boring, low-cost path is still the most effective.
And the gold standard for that is, of course, Warren Buffett's advice.
Right. Just a simple mix. 90% in an S&P 500 index fund and 10% in short-term bonds.
And the numbers back it up, don't they? The S&P has returned over 15% in the last decade and nearly 10% over the last 30 years.
Exactly. When your alternative has to generate a 14% IRR just to maybe break even with the index fund after fees, the choice becomes pretty obvious. The low-cost, low-effort option is mathematically superior.
There was also a mention of the Ray Dalio all-weather portfolio for people who are maybe a bit more risk-averse.
Yeah, that's a different kind of boring.
Um,
It's built to do okay in any economic, weather, inflation, recession, you name it. It won't give you the huge growth of the 90-10 portfolio, but it might help you sleep better at night. It's for stability, not for shooting the lights out.
And for those who are still determined to get some kind of alternative exposure, what was the one legitimate path mentioned for non-accredited investors?
That would be something called a Reg A fund. It's a specific legal structure under SEC Regulation A that's designed to let non-accredited folks invest in things like private companies or real estate up to a certain limit. Phoenix Capital was mentioned as an example.
So if we pull all this together, what's the big picture? It seems like the strategies of these financial geniuses are fascinating, but the real takeaway is that the main obstacle isn't a lack of knowledge.
Not at all. The real hurdles are cost and the regulatory gatekeeping. The book promised to give you the keys to the kingdom, but the reality is that the safest, most logical path for most people is still the one that avoids that kingdom entirely.
That's the fundamental tension. The whole search for the Holy Grail isn't really about what to invest in, it's about who is even allowed to play the game.
Which leads us to our final provocative thought for you to take away from this deep dive. If the most valuable asset isn't a strategy, but just the legal status to access a strategy, being an accredited investor or a qualified purchaser, how should that change your own financial plan?
Should you focus all your energy on trying to achieve that status so you can open those doors? Or is it smarter to just master the simple, proven, low-cost strategies that are already available to everyone?
Something to think about.
That is a deep dive for another day. Thanks for joining us. We'll see you next time.